All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 11 of the Macro Corner podcast, proudly presented by Blue Line Futures. I am your host, Paul Wankmuller. The Macro Corner chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every weekend. Not a client? Reach out to info@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. My guest today is Giannis Mindall, and the topic of today's podcast is markets move with macro expectations and expectations change. Welcome to the podcast, Giannis.
Hey, Paul, thanks so much for having me back on. A lot to cover today.
Absolutely. Now we've seen a move up in the equity markets coming out, and this is what I think that you were speaking about. What expectations change? Maybe there is a little bit less worry out there with the inflation game. We saw some numbers coming out in the past 2 weeks that have seen inflation slowing, and possibly have we seen the top of inflation?
Yeah, so that's a $1 million question everybody's asking right now. We first saw ISM manufacturing prices at 60, which was a steep deceleration from previous data points. Then we got, of course, CPI on that number. The stocks really took off, and then that CPI number was followed by PPI, which tends to be a leading indicator for consumer prices, PPI being producer prices. So
Let me pause you for a sec, Giannis. I just want our listeners to know. So, everyone does talk about PPI and CPI. What is the ISM manufacturing price? What is that index?
Yeah, so ultimately, this is a survey of businesses that the ISM does. And what they do is different businesses respond to the ISM saying that they see price levels at any given point. And ultimately, it's a survey of different manufacturers of different goods that flows into that equation. And that number came out before CPI and PPI. But yeah, ISM is just another way of measuring manufacturing-based inflation, which
those are input prices, right? Yeah, those are input prices for the companies. They're saying, hey, it costs me a little bit more to run my business.
Exactly. So all sorts of manufacturing plants, you think of autos, you think of, now it's going to be more of a theme again with semiconductors, all kinds of manufacturing going into that.
Okay, that sounds good. So yeah, so we see this coming off a little bit. Looking back to 2012, it looks like the bottom of the range is around 35, and the high of the range here maybe around 90, and it looks like we're coming back to reverting to the mean around 60.
Yeah, so the way this ISM number works is above 50 is an expansion, meaning in this case, prices are inflating, and below 50 it is a contraction, meaning prices are deflating. In this case, we still see prices inflating on a technical basis, but we see a rate of change deceleration, which is really what markets are looking for based on the commentary that Jay Powell gave during the July 27th press conference, where he mentioned, yes, the Fed is, of course, concerned with the absolute level of inflation, but then they're really paying close attention to the directional movement of these different inflation gauges. And we do have seen some anecdotal and increasingly so evidence that we see some sort of disinflation going on right here. And this is also reflected in inflation surprise indices, which is just a measure for relative to expectations. Where do all these inflation figures come in? As the inflation surprise indices come down, that means that relative to expectations, inflation is not surprising as much as it used to in the recent past. And that's what markets are paying real close attention to, given that they are so afraid that we have central banks hiking into an economic slowdown. But if the inflation is maybe less bad than feared, then that tightening into an economic slowdown may not be as much of a problem, as the economy is maybe not as bad as people thought initially.
Right, right. And the employment numbers are still looking pretty good. And I took a road trip over the weekend. We were able to fill the gas tank for 360, which isn't too bad. I think that that plays into a lot of consumers' minds as well. I think the national average for gasoline is under four, if this week, if not last. But yeah, I agree with you there, Giannis. I do think that these numbers are confirming what a lot of people are seeing, as some of these numbers are lagging indicators, right? So these numbers that come out are telling the story of a month or two ago. Is that would that be fair to say?
Yes, so I mean the numbers that we ultimately see with economic data in general is that we are looking in the rearview mirror
Hmm.
when we look at things like CPI, like the PPI, and also the ISM. But it is data on a 1 month lag, generally speaking, so it's pretty um, timely, I would say. But then also you extrapolate, and what markets do is, generally speaking, they do extrapolate existing numbers, which means with the CPI, for instance, they saw that there was a 0% month on month percentage uh, number that we got, which means if you get 0% on an ongoing basis up until the end of Q1 of next year, that would mean that we come down substantially on the year on year number. And that's ultimately what markets do. They get one number, or they get some sort of anecdotal evidence, or
Hmm.
a whole gamut of numbers in this case, and they ultimately look out and extrapolate based on the recent data points. And that's what we got right here. We look at things like Goldman Sachs most shorted index, stock index, which has really led this rally. I mean, this rally in equities has really been led by the most shorted stocks. We now see a comeback with meme stocks trading all the way up there. But yeah, I mean, this is ultimately extrapolation. I mean, given how easy information flows these days, it really comes down to what markets price in and the rate at which they price in these days.
So right. So if going back to that point, let's say that okay, so maybe investors are not as afraid. Maybe investors are coming back a little bit. The retail investor or active management. What are we seeing in the markets with regards to actively managed money, or maybe passively managed money? What is that story with regards? I mean, the S&P, I think it was the middle of June that we've seen that low, and we're up back, we're over 4,300 there. So what is the money flow telling us over the past month or two?
Yeah, this is really where it gets interesting, and we sort of tried to articulate it in the past two podcast episodes too, where we talked about money flows and ultimately a market comes down to supply demand dynamics. And what we've seen with active management is during that low in June, as you alluded to, some of these active managers have had as low as 20% equity exposure in the aggregate. So what that means is 20% equity exposure. Usually they are at 80% or above, or call it 70% or above. I mean, you think of traditional long short portfolios where managers can put on certain type of leverage, and that would get them above 100% equity exposure. But then you think of traditional 60/40 portfolios for pensions, things like that. And to have a 20% equity exposure in these portfolios is extremely low. And that's what we've seen. And ultimately, that's what's leading to this bounce back in stocks. We talked about FOMO, the fear of
Yeah,
materially
absolutely.
underperforming in the past. And when you have a 20% equity exposure, and you see equities rallying, then you need to put exposure back on. That's what we're seeing right now. You see a similar theme playing out with hedge funds specifically. A lot of them have been all in on the inflation trade. When you look at some of the inflation uh, driven assets, that's why hedge funds have really put on most exposure in the recent past, and they have not put on as many tech related trades, things that have worked before this inflation really kicked in. So there's really an imbalance as to how people are positioned. and right now that's getting reflected in this risk-on sentiment that's occurring in markets as we speak.
Just two things for our listeners. You said FOMO, that is the fear of materially underperforming. We can say that fund managers are chasing returns if their buddies or other funds within their range are doing better than them. And then you'd mentioned 60-40. That would be 60% equity, 40% bonds, if I'm not mistaken.
Yes, that's 60% equities, 40% bonds. And ultimately, as a portfolio manager, you compare against the benchmark, which just means, say you are a long equities only
Hmm.
manager, you might compare against the S&P. If
Right.
you are a 60-40 portfolio manager, you compare against a traditional 60-40 portfolio. And if you are overweight or underweight in certain allocations, then that means that you can underperform or that you can outperform. But ultimately, you need to be somewhat close to that benchmark, or else you're sort of violating your fiduciary duty as well. Um, but yeah, I mean, when we look at some of these survey data points, it definitely speaks to the fact that there has been an imbalance as to where people have been allocated. And the same thing is also true on the individual investor sentiment, which measures sentiment amongst retail investors. When we look at recent data points, we see that the retail investor in aggregate has been 60% bearish. That exceeds what we saw during the COVID shock. So that was basically when everybody was thinking that the world would come to an end. We
Right.
exceeded that. So that just speaks to the fact that there has been some really bearish sentiment out there, and we are in the process of reversing some of these trends. And how long that's going to persist is an entirely different question. But what we can say is how people are positioned now and how they are positioned relative to historical norms.
Just a little tidbit. I do remember back in 2021, Congress was about to pass that bill. It did not pass over the weekend, and the S&P opened limit down. That was not fun. But yeah, sentiment for our listeners, that just means how investors are feeling about the market. I believe that is a survey as well. But just playing a little devil's advocate here, right? So we got equities coming off the low since June. Maybe inflation is slowing down. Maybe we've hit that peak. But there's one thing that kind of goes against all of that, and that is credit card delinquencies and also the amount of credit card debt out there. I think we hit 1.1 trillion last week, which is the highest it's ever been in credit card debt in the U.S. And I do see here that the amount of delinquencies for credit card, I guess delinquencies in credit card debt is starting to rise. So we're telling one story, but what is this other side of the story that we're seeing?
Yeah, so ultimately, this other side of the story is the real economic backdrop and how that's going to develop. As you alluded to, credit card debt has increased. When we speak to delinquencies and look what's going on that side, yes, delinquencies have recently ticked up as measured by some of the New York Fed data that they publish, but
Mhm.
these delinquencies are relatively speaking still at extremely low levels. So
Okay.
when we think of what the common investor sort of defines as a recession and as conditions that would be extremely worrisome in terms of the Fed hiking into these um, economic circumstances, then one would think that credit card delinquencies would be a lot higher in that landscape of a recession. Where that's ultimately going to lead to is we'll have to see whether these delinquencies keep ticking up and whether the revolving credit facilities show an increase in the amount of credit card debt outstanding. As we talked about in the past too in the podcast, the revolving credit, the credit card debt, is ultimately what the lowest income spectrum of the population uses in order to afford their daily living expenses. So
Right.
if the Fed keeps tightening and keeps raising interest rates and keeps withdrawing liquidity, then that ultimately becomes less affordable, and it's going to hit the bottom decile of the population the most. So ultimately, we'll see how this is going to unfold going forward. But one of the longer term risks, if indeed higher interest rates persist for longer, is that some of these people won't be able to afford the outstanding credit. First, they take on the credit, and then it becomes a question of how long they'll be able to afford it. And that's what we're going to see in the coming weeks and months, how that data is ultimately going to evolve, and whether these delinquencies are going to return to some sort of historical norm, or whether it's also going to show a more profound development where maybe some of these delinquencies tick up substantially, at which point it becomes a more systemic problem for risk assets at large. But yeah, as you correctly said, I mean, we have one set of circumstances in the real economy, but then also you had this drop off in risk assets, and it's now becoming clear sort of how negative sentiment got and how real macroeconomic data ultimately unfolded versus the worst expectations, and what was ultimately feared in that move in risk assets.
So relative to historical standards, I think that we're still in the lower quadrant, especially for the first quartile of auto loan and credit card delinquencies. We're still looking pretty good, and I'm sure the Fed's paying attention to this. And even though we are ticking up, it looks that we're doing pretty well on a historical basis.
Yes, that's exactly it. And we turn to the lowest income quartiles here, and those numbers are still really low. So
Yeah.
this is not at concerning levels just yet. How it's going to unfold is a different set of questions. But yeah, I mean, delinquencies remain low for the time being, and they are low compared to historical norms. So yeah, we'll continue to see the data evolve, of course, and whether this current issue of extremely high revolving credit will turn into a more systemic one, or whether delinquencies are going to stay low.
So let's close out the podcast with one last ratio here. So we've seen the Fed balance sheet grow over the past, my career anyway, in finance. What is a correlation, do you believe, with the Fed balance sheet and either equity markets or risk assets in general? And as we do see this starting to unwind, what do you think this relationship's going to be going forward?
Yes, so this is probably the most important question in all of macro right now.
Okay.
When you look at that quantitative tightening, meaning the roll off of treasuries and mortgage backed securities off of the Federal Reserve's balance sheet that's supposed to be happening right now, it's not happened to the extent that they announced initially. Why that is, it's certainly not due to settlement issues, because that those settlements would happen in a shorter time frame than and it's just not happen. I mean, we'll see what they are ultimately also going to announce in the September meeting, but we are expected to see a doubling of the QT. And one of the main questions that all of macro is asking right now is, what is the direct effect of QT, and also how has QE in the past affected financial assets? Of course, the common knowledge sort of is that it's directly flowing to financial assets. Therefore, stocks go up, and that's sort of underpinned a bid in risk assets at large. But when we look back in history, and really at the onset of QE up until now, we saw a really high correlation of the Wilshire 5000 index. This is just another S&P 500, basically, except
Okay.
that it includes a lot more names and a lot more stocks. But when we look at that correlation, we see that from the beginning of QE up until right now, there's been a period from 2008, let's call it, up until the end of 2015, where you had a really close correlation. Then you had deregulation, you had tax cuts, and therefore sort of real productivity growth, real economic growth. And at that point, stocks were able to detach from the amount of assets on the Federal Reserve's balance sheet. But now that we are sort of moving back into a similar economic state as we were in post great financial crisis, that ratio is sort of increasing again, and that's ultimately why the effects of QT will be so interesting to watch. If we indeed see the Fed increase the balance sheet runoff to close to $100 billion starting in September, then the effects will probably be a lot more important than many people think right now. And I mean, we put on more than $3 trillion on the Fed balance sheet on the back of uh, the initial COVID shock. And that's, of course, supported risk assets and propelled those higher. And then we'll see the opposite side of the coin and how that affects financial assets starting especially in September. I mean, as I said,
Yeah.
the settlements have not really reflected as much QT as the Fed initially announced, but we'll see whether they ultimately take up their game as it pertains to QT, and then also double the size of it starting in September. And what the effects are going to be will be really interesting.
Yeah, we're only 9 days away from Jackson Hole. Will I see you there, Giannis?
I will not be in Jackson Hole, but we will keep doing the podcast. That's for sure.
Yeah, we definitely will. I'll let I'll let Jerome know that you were looking for him.
That sounds good.
Sounds great. Giannis, thank you so much for joining me on episode 11 of the Macro Corner podcast, proudly presented by Blue Line Futures. Again, I'm your host, Paul Mike Muller. The Macro Corner chart book is available in the description of the podcast on BlueLineFutures.com, as well as attached to the email sent to clients every weekend. Not a client? Reach out to info@BlueLineFutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. My guest today was Giannis Meindahl. And again, thank you so much for joining me. And let's see if we can get you a flight out to Jackson Hole.
It was a pleasure being here, and I look forward to recording next week again. Thank you much.
So excited. Thanks, guys.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.